Okay, welcome to today's lecture. We are quite in the middle of our discussion of bank accounting, German bank accounting to be precise. And now on the next couple of slides you will see that because the structure of the bank balance sheet is the same, or more or less the same as the one for industrial firms. Of course, you have an asset side, you have a liability side. On the asset side, you have the financial assets and some other assets. Some banks actually do own real estate and they own 1 or 2 buildings. But of course, the majority and the large portion of the asset side of a bank's balance sheet is made up of financial assets. And financial assets usually can define them as entitlements to future payments, for example, if you grant a loan. And we've actually seen that in the very first lecture when we had a look at the balance sheet of a savings and loan association. You could see that even from the balance sheet of a bank, you can immediately extract some information on the type of business they are doing. And if you see that a bank has a lot of granted loans, on its asset side, you can see that it's active in traditional lending business. So you have granting of credit. Banks will, of course, also purchase and trade with securities, and these are the financial assets you have on the asset side. Now, significant characteristics for the allocation to the individual balance sheet items and the balance sheet parts within the financial instruments are usually the possibility or the ease with which the bank can refinance with a central bank, the liquidity or marketability of the financial instrument, and the legal status of the holder of the financial instrument. Now, as you can imagine, for an external investor and for a stakeholder, it is imperative to see of what quality the financial assets are that are on the balance sheet of the bank. And it makes a difference whether you have a financial instrument that is more liquid and that can also be used for refinancing with the central bank, or if you have a financial instrument and a financial asset that is rather illiquid and it cannot be deposited with the central bank in order to get central bank money. So this is the way to distinguish the different types of financial assets. You can see that on the next slide, and I've left this in German because it doesn't make too much sense to translate it because it's still a German bank's balance sheet. We distinguish between financial assets, which are referred to in German as Forderungstitel, and you can see that depending on the question whether these financial instruments can be used for refinancing agreements with the central bank, if that's possible, they go into section A2. If they are claims with the characteristics of a financial security, Wertpapier in German, they go under A5, and everything else, depending on the question whether it's a claim against customers or other banks, other credit institutions, financial institutions, they belong into sections A4 or A3. So these are the distinctions you make when it comes to financial assets. So at first, of course, you can see securities that can be deposited with central banks are, of course, of the highest quality because central banks usually only accept securities that are completely risk-free. Central banks are not the bad banks or the dump for banks' bad loans and bad securities, but these are the assets of the highest quality. So they go into A2. Then you have claims against customers, A4. Claims and entitlements against credit institutions, A3, and securities, financial securities, A5. Okay. Now, the debt securities. We have some further sections on the asset side of the bank's balance sheet. You have A6, A7, and A8, and you can see that in A6 you have shares and other non-fixed income securities. A7 is investments, now that's quite general, and A8, these are holdings. If you have an investment in holdings and other companies, this goes under A8. And you can see that shares, so stocks, they go into A6 only if they are not included in A7 and A8. And here the important question is whether you are holding these shares and these stocks of companies as a long-term investment or simply for trading. If it's a long-term investment, it's probably included in A8 or as a long-term investment. And this is rather, this is really what A7 is about. It's the long-term investments. So if it's long-term investment, A7 might also be a holding. And if it's neither A7 or A8, so it's rather a short-term investment used for trading, it goes into A6, shares and other non-fixed income securities. Other instruments similar to shares, they always go into A6. And if you have an investment in a limited corporation, which under German law is a GmbH, a Gesellschaft mit beschränkter Haftung, a corporation with limited liability, they are not allowed in A6 because it's not a tradable security. If it's included in the consolidated financial statement, it goes into A8 as a holding investment, and it has to be included in section A7 always, unless it's A8. Okay. Now, yeah?
What is the consolidated financial statement?
Konzernbericht in German. So if you have a holding company, it's the financial statement of the holding. In German, it's Konzernbericht. Konzernabschluss. Yeah?
The number after the A, does it mean low number is low risk and high number is high risk? Or?
I think that's the basic idea, because you can, if you remember, it's not exactly risk versus or high risk versus low risk, but rather liquidity. Because if you remember, the basic idea of the bank's balance sheet under German accounting law is that it's the other way around than in a regular balance sheet. So you go from, correct me if I'm wrong, you go from extremely liquid down to rather illiquid. And in the normal industrial, or in the normal balance sheet of an industrial firm, it starts with real estate, machines, and you have cash and cash equivalents as the lowest entry in the balance sheet. For banks, it's the other way around. And this is why, for example, you have these positions, A2, at the very top, and then it goes down, and investments in holdings, these are further below.
So A1 would be cash?
If you go back, you can see that, yes, this is cash. And here, if you are interested in the German equivalent and the German translations, just look at the German script and the German set of slides, or simply look at this extract from the Rechnungslegungsverordnung für Kreditinstitute. And here you can see cash is the first position, and then it's financial assets after that. And of course, you can also see that you have this section, section 12, this would be the real estate investments and machines and everything else. And usually banks do not have these. Okay. And yeah, we can go through the remaining sections, A6, shares and other non-fixed income securities, equity-like securities, interim certificates, investment shares, warrants, profit participation certificates, order papers, other non-fixed income securities, and you can also use paragraph in section 271, the German Commercial Code, in which Participations, Beteiligungen in German, and shares in affiliated companies are defined for corporations. So this is very detailed, one has to admit. Trust assets, 9, can be held by a bank in its own name, but on behalf of third parties. Compensation claims against the public sector, including bonds from their exchange. A10, intangible assets. Let's go back. So you have Ausgleichsforderungen gegen die öffentliche Hand, einschließlich Schuldverschreibung aus deren Umtausch. These are rather specific parts of the balance sheet of a bank, and I think we don't need to go into detail. It's simply, the general idea is that investors and stakeholders should be aware of the liquidity, the risk, and the counterparty of each of these securities. So if you have, for example, a claim against the public sector, against a municipality or a county or the federal state, this is, of course, a security that is a different nature, is of a different nature than, for example, a financial share or stock. Okay. Intangible assets includes acquired concessions, property rights, intellectual property rights, and everything else. And this corresponds to the same section in an industrial company's balance sheet. But one has to say that usually intangible assets are rather, or used to be, rather limited with banks, but with fintech companies becoming more and more important, we might see an increase in intangible assets in banks' balance sheets because, well, banks need to be more innovative. Okay. Property, plant and equipment, pending deposits on the subscribed capital, owned shares or shares, other assets, accruals and deferrals. These are the regular parts of a balance sheet, and you probably know these. Okay, deficit not covered by equity. This is, of course, not an asset, but it's the residual of the balance sheet in case asset and liability side do not match. You probably know this. The total assets on the asset side and the liability side should always match. And if they do not match, well, you have a loss or a gain, and this will be included in the income statement. But here in this particular scenario, you can also include it as a residual position on the asset side or the liability side. Okay. Now, how does the liability side, how does debt look like for a bank? Again, this is, of course, also much more important than the liability side of an industrial company, because if we take a medium-sized industrial company, what liability positions will this company have? Usually large portion of equity. It will have some bank loans. It might have issued some corporate bonds, and that's it. So you have equity, you have debt, and usually there are only few creditors in this case, and you have maybe a couple of banks, and it's still a question whether a mid-sized company would even issue a bond. Only large companies usually issue corporate bonds. For banks, this is totally different, because at first you have depositors. You have depositors with the bank, and these the deposits show up on the liability side, and they get their financing from various agents in the financial sector, the central bank, other credit and financial institutions, probably some investment corporations, the depositors, and so on. And they also issue bonds. So the liability side of a bank is usually also more sophisticated and more diverse than the one of an industrial company. Now again, the items are partially subdivided in the same way as the corresponding items on the asset side. And in line with the breakdown of receivables, a distinction is made between liabilities to customers and liabilities to banks with the same maturity structure. And the subdivision between receivables and securities corresponds to the differentiation between liabilities. This is P1 and P2. The P and the A stand for active and passive, the German words for active, passive, and the asset side and the liability side. So this is the first entry on the liability side, second. And you have securitized liabilities under P3. Securitized liabilities, they may not be registered securities, must be securitized in debt instruments, and must be transferable and marketable. We have trustee liabilities, and these are the counterpart to trust assets on the asset side. You have other liabilities, P5, they include all liabilities that cannot be assigned to one of the previous four entries. You have accruals and deferrals. You have provisions. They are used by both banks and non-banks to capture and to grasp uncertain obligations. Provisions for anticipated losses from pending transactions, for example, option and derivative transactions. They are particularly important for banks, of course, because they engage heavily in derivatives tradings. And you also have special reserves. You can have a look at the German equivalents for a moment. Here you can see these are the liabilities with financial institutions, the liabilities with customers. These are the deposits. You have securitized securities and claims. Then you have 3A, the trading Handelsbestand, trading securities. Do you have an idea what securities this might be and what financial instruments on the liability side? If you buy a security, it will pop up on the asset side. But why is the trading? Why do you have a trading and a position for trading securities on the liability side? These are derivatives. If you engage in a derivative and take the short position, you have an obligation and you receive a fee for the potential and the possibility that you might pay out if the buyer of the option or the buyer of the derivative exercises the option, for example. So these are derivatives and the short position on derivatives. Treuhandverbindlichkeiten, these are trustee liabilities, and it goes on, and finally under P12 you have equity, Eigenkapital. This is important, the provisions. Why are provisions interesting? And you might not see this here, A, B, and C. Actually, in an English balance sheet, this becomes much clearer. For what types of business and for what types of situations does a bank need to make provisions and to hold provisions on its liability side? In English, one of the most interesting sections on the liability side of a bank are the loan loss provisions. And what are loan loss provisions?
Something you have to lay back in case the loan defaults?
Yeah. If you know you have a loan that is close to default, you are obliged under law to build loan loss provisions. On the asset side, you have to mark those loans not as an asset. For example, I think it is A5. Where do we have it? A3. No, 4 claims against customers and claims against financial institutions. But you have to put them under NLPs, NPLs, and non-performing loans. You have to single them out on your balance sheet and show stakeholders that a percentage of your loans are non-performing, so that you know, okay, this bank has, say, 1 billion euros given out in loans, and 10% of these loans are non-performing loans. They might still recover a certain amount of their money, but they are non-performing, so they are already in default or they are close to default. Quick question in between: what does in default mean when you think of a loan? It might simply mean that your customer has failed to pay the last payment and he's in default like 5 days overdue. There are certain rules that define when a client is in default, and in default does not always mean 100% of the money is lost. It might simply mean that your customer has forgotten to pay forgotten to make the last payment. So his payment is overdue for a certain, let's say, 1 week or 2 weeks. You might still get your money back, but when it comes to accounting, it's a non-performing loan. So a part of your loans are now in the non-performing loan section, and you need to make a provision for the potential loss that has now become more probable than before. And non-performing loans and loan loss provisions are a very good indicator of the risk the bank has taken. If you see a bank who has a bank that has 50% in non-performing loans, you can immediately incur that this bank is taking on much more risk than a bank that only has 10% non-performing loans. And if loan loss provisions are higher, you already know that they are taking on more risk and they are facing a higher loss. Okay, so these are the non-performing loans and the loan loss provisions. And these are, of course, quite interesting and quite instructive when it comes to measure a bank's risk.
Yeah, if you miss the last rate to pay your loan, it's a defaulted loan, but what's close to default?
Well, I mean, with close to default, I mean that in a naive way, in a trivial way, we wouldn't call this a default, a 100% default. Because if you would ask someone, if you would ask a layman, what does it mean to be in default? He or she would immediately say, well, a person is 100% bankrupt. He or she cannot pay back his loan. But in a more professional way, a loan that is in default might be a loan to a company or a person who is bankrupt, but it might also mean that the payments are overdue. So the bank might still be able to recover 100%, but not at the right moment. So this is what I mean with close to default, because it's the same way for companies. Companies might not be bankrupt, but they might be close to default. And for most companies, you can see this, for example, when their rating decreases. And most banks will have some rules that, for example, if your credit rating decreases under a certain threshold, the company is not bankrupt in a legal sense, but the bank will probably view it as a loan that is in default. Okay. You have subordinated liabilities, participation rights capital, in German Genussrechtskapital, a fund for general banking risks, and so on. And finally, equity. Now with equity, you have gezeichnetes Kapital, subscribed capital, capital reserves, the different types of retained earnings, and the balance sheet profit or loss if you want to include it on the balance sheet. Now, if total assets balance out on both sides of the balance sheet, then it's okay. But here in this very special type of accounting under German commercial law, it's also included on the liability side. Okay. You also have certain parts which we refer to as items below the balance sheet line, which simply means that these are additional entries and additional information that is given to investors and stakeholders, but which are not included in the calculation of the total assets, unter dem Bilanzstrich. So one could also say these are off-balance sheet items because they are not in the balance sheet per se. For example, transactions that may result in a liability or in credit risk for the bank. These below, you can see why I haven't distributed the slides yet, below the balance sheet line, or these are off-balance sheet items. Contingent claims, other obligations, so everything that is an obligation or might turn into an obligation to the bank and from which the bank might incur a loss and has some risk exposure. These items are included as off-balance sheet items, but they are not included in the calculation of the total assets. Okay. Now, at this point, you know what the general outline and the general structure of the German bank's balance sheet looks like. And I would say the rest of accounting is just concerned with valuation. You know where to put the different types of securities, you know where to put the different types of liabilities, and this is not a very big question. The important question usually is into which position does each security go, because there might be you might have different opinions on the question of liquidity and marketability, and what is the value of the security. You need to enter a figure and you need to come up with the correct value. And valuation is, I guess, one of the main topics of the German commercial law when it comes to banking. And this is the next part. And it's interesting to see the difference between insurance companies and banks here, because what would you think is more interesting for banks? The valuation of the asset side positions or the liability side positions? Asset side. Banks hold loans, securities, bonds with municipalities, the state, customers, other financial institutions, and so on, and they have derivatives positions. And usually it's critical to have a correct valuation of the asset side positions. For insurance companies, it's the other way around. It's much more important to evaluate the positions on the liability side. Why?
So your customers have claims against you.
Yeah.
And it might be the case, for example, when you get...
They have contingent claims. The problem is that they have contingent claims. Now, if you bring your money to a bank and you deposit it with the Savings and Loan Association, it's quite clear what obligation and what liability you have as a bank. If I bring 1,000 euros to the bank has a liability of 1,000 euros. In the worst case scenario, it will have to pay out 1,000 euros, so you enter 1,000 euros deposits on your liability side. The bank then goes on and gives out 10 loans to 10 persons or 10 businesses, and it faces a risk. The payback and the payment on these loans is contingent on the probability of default of the lenders. This means that it's much more difficult to value the asset side positions than the liability side positions. For insurance companies, it's the other way around. The insurance company will earn premiums, and if, for example, you've taken an insurance contract, if you've signed an insurance contract, what will happen if you default? You will not be able to pay the premium, and the insurance company will immediately cease granting you insurance protection. So the insurance company is on the safe side. If you don't pay your premium, there is no insurance. But it will use the premiums on its asset side, it will buy up risk-free bonds and maybe some real estate. That's not too difficult to value. And on the liability side, it might be forced to pay out an insurance loss. It might be that the customer has a claim against you as an insurance company. But this is contingent on the probability of you as a customer incurring a loss. For example, if you have theft insurance for your bicycle, if you keep your bicycle, there is no change. The insurance company is lucky and doesn't have to pay out anything. If your bike is stolen, the insurance company will have a contingent liability. And this makes it much more difficult to value the liability side positions, because this is where the insurance policies enter the balance sheet, and it's the other way around for insurance companies. Now, what are the basic valuation problems? We have special valuation rules that apply to banks. These are regulated in paragraph 340E to H under the German commercial law. And unless you have a special valuation rule, the valuation rules for corporations, for Kapitalgesellschaften, these apply here, and these are written down in paragraphs 279 to 283 of the German Commercial Code. And if it's not regulated for corporations, but if it's very general, we have to go back to 252 and 256 of the German Commercial Code. Now, what are these general rules? For example, the principle of prudence. You have to be prudent, which means that gains may not be recognized and may not enter the balance sheet and the income statement in profit or loss until they've realized. Das Realisationsprinzip. So if it's still, if you have a gain, if you have a profit, you must have incurred that profit, and it should not be, and it must not be a likely profit. It should have been realized. Imperative principle: potential losses must be taken into account by setting up provisions or making extraordinary depreciations. For assets, the lowest value principle applies. For liabilities, the nominal value principle applies. We have in German fixed vocabularies and fixed coined terms for this. Niederstwertprinzip is the principle of the lowest value. And this simply means what? If you have a financial asset and, for example, a loan, and there are several ways to come up with a value, you have to take the lowest one. Because German Commercial Code is all about protecting investors and protecting customers and being on the safe side. And this is where this comes to mind. The principle of the lowest value simply means that when it comes to valuing assets, you always take the lowest probable value. I mean, the lowest possible value would always be zero. You don't do that. But you have to be prudent and you have to be cautious when it comes to the valuation of financial assets. For liabilities, you take the nominal value. As I've said, if I bring 1,000 euros to a bank as a deposit, this is the nominal value. And the bank, in any case, has to pay back 1,000 euros. It cannot depreciate, it cannot increase. Usually it cannot increase. And this means that you take the nominal values for the liability side. We have a strict version and a moderate version of the lowest value principle. German, the same, strenges Niederstwertprinzip. And the question which one of these two principles is applicable depends on whether the asset belongs to fixed or current assets. So as this subdivision is actually missing from the balance sheet of a bank, there is a special legal provision 340E, section 1 of the German Commercial Code. And here assets are typically treated as follows. Application. The strict principle of the lowest value is applied to A2, A3, A4, A5, A6, and A15 of the asset side. And a moderate version is applied to the remaining parts of the asset side, which again is simply a result of the fact that German accounting is extremely cautious. And everything on the asset side of a bank that might change quickly in value. So if you have, for example, securities, if you have loans, you have to be extra careful. So this is why you have two principles, and a strict application of the lowest value principle and a moderate one. So what is the distinction? It actually is that if the value of the financial security decreases, the question if you have to depreciate and if you have to use the fair value of the security exactly at the same time when the value depreciates, or whether you can stick with the old historical value. And if you have the strict application of the lowest value principle, you more or less have fair value accounting. Fair value decreases, you have to depreciate your asset on the balance sheet immediately. So you have the financial assets, which could be investments, long-term investments. You have the moderate application, so write-downs and depreciation is only done in case of a permanent impairment. Does everyone know what that means? If you have a financial asset, let's take a value of 1 million euros, and you have some moderate changes in price. It's worth 900,000, then 1.2 million, again 950,000, and you keep it as a long-term investment. German law says you do not need to do a write-down and write-off. You can simply keep the 1 million euros on your balance sheet because you're keeping it as a permanent and long-term investment. Only if you see, okay, the position, the security has permanently lost in value, you have to do a write-down. For everything else, if you keep it for trading, it's a short-term investment, you have to depreciate and you have to write down each and every one decrease in value. This is the strict application of the lowest value principle, and you can see this is done for the trading portfolio, for the liquidity reserve, and here you have 253 section 2 and 253 section 3 of the German Commercial Code. You don't have to memorize the sections in the paragraphs. You just have to keep in mind that you have two principles for the valuation of financial asset, and it depends on the nature of your investment, on the maturity of the intended maturity of your investment. If it's long term, you can keep the old value unless it's a permanent impairment, and you have to go to fair value accounting more or less in case it's the trading portfolio or liquidity reserve. So if it's a short-term investment. You have some discretion. You have the first level. You have discretionary powers when it comes to allocating the financial asset to a certain position on the balance sheet. So if it's a financial asset, you can use the moderate principle of the lowest value. If you argue, and your CPA accepts this, if you argue no, it's the other way around. If you say, okay, it's a trading portfolio or liquidity reserve, you have the strict application of the lowest value principle. If you argue, if you have good reason and your CPA accepts that an investment is a long-term investment, you have discretionary power to put it as a permanent and long-term financial asset in your balance sheet. So this is the first level of discretion you have. Simply by including a security in one section of the balance sheet or another. The second level is the discretionary power in the use of valuation options within each security category. So for example, for the first section for financial assets, you have the write-down option in the event of a temporary impairment. Now, if you see that your position has lost in value, even for a long-term investment, you can do a write-down. You are not obliged to and not forced to, but you can do it if you want to. Might be an option if you want to do earnings management. You can decrease your profits by doing a write-down on your financial assets. And finally, if the reduction in value is temporarily, you could still argue that this is not a permanent impairment. Still, the CPA has to accept it. Your public accountant needs to accept it. So it's a discussion with the CPA. And it goes on. You also have a write-down option for expected fluctuations in value. And again, for the liquidity reserve. And here, are there any future impairments to expect? So also for the liquidity reserves and the trading portfolio, for the short-term investments, you have some discretion that you can already do a write-down in case you expect a future depreciation, a future decrease in value. So it's you do have some discretionary powers. Okay. Yeah.
Am I right for the trading portfolio? Is it correct that because we are not allowed to add some value?
No.
So under German commercial code, it will end up with chance of like hidden values.
Yes.
Especially for the trading portfolio.
Yeah. To be precise, fair value accounting is at that point is quite different when it comes to profits and increases in prices, and it's how should I say this? Accounting isn't as boring as it might seem at this point, because fair value accounting has been named one of the few pivotal points in the financial crisis. Because this might seem to be a rather theoretical discussion, but it's highly practical for banks, because banks need to know where to put their financial assets and their securities on their balance sheet. They need to know when to do a write-down. And of course, during the financial crisis, this was very critical to banks, because when banks were forced to do fair value accounting, and also in this case, in some banks that held these securitized bonds and securitized credit portfolios as a short-term investment, they had to do immediate write-downs in the billions and billions of dollars and euros. And if you are doing your balance sheet under IFRS, and if you have to do fair value accounting, this simply means that you have to write down immediately if your position depreciates in value. And this is critical, because right now you can see that most of these credit portfolios that banks used to have, they weren't worthless. At that point, the market collapsed for example, CEOs and collateralized debt securities. The market collapsed, and if a market collapses and there's no liquidity, the fair value is zero, and you have a complete write-down. And this is what forced immediately immense losses to almost all banks that were under fair value accounting and did their balance sheets under fair value accounting. So it's not simply a question of is our earnings 1 or 2% higher or lower, but this is actually quite interesting from a research standpoint as well. Now, valuation of claims. Yeah?
After what time is an investment labeled as long-term investment?
It sometimes depends on the type of investment. For some investments and some securities, it's obvious that it's not a long-term or short-term investment, and in some cases you have to designate it as a short-term or long-term investment, and it depends on what you are intending to do with it. And usually these are these are the sources for discussions with your CPA. And the CPA, you have to convince your CPA that these positions actually do belong to the trading portfolio or the your financial assets. In German, this is the distinction between Handelsbuch and Anlagebuch. But this is not, usually this is not a big question and not a big problem, because in many cases it's quite obvious. When you see, for example, that some securities are traded within the investment bank branch of a bank, you know this is a trading portfolio. This is not done as financial assets. In some cases, if the bank holds, for example, stocks of industrial companies, it's quite clear that this is a financial asset. Yeah. Also, when it comes to bonds, it's quite clear that most bonds are held as a long-term investment. Now, these were the securities. Now we turn to claims against customers and other financial institutions. Credits and loans are often granted or acquired with a disagio or agio, that is, the payout amount or purchase price does not completely correspond to the total nominal repayment amount. And in contrast to non-banks, banks can account for loans at nominal value as long as receivables are not included in the trading portfolio. A disagio has to be included in the accruals and deferrals section on the liability side, and has to be amortized on a scheduled basis in the following years. And for a premium, there's a choice between immediate offsetting as an expense and the inclusion in the accruals and deferrals on the asset side. When calculating the carrying amount, one has to determine whether the carrying amount of the previous period is appropriate, considering the credit worthiness or the rating of the debtor. And in case of recognizable default risks, or country risks, you have to make an individual value adjustment. And in case of latent risk, which are not yet obvious, you can do a flat rate value adjustment for your loans. And for risk prevention, you can also form risk reserves on the liability side. So you have a nominal or the residual receivable amount, which is the book value of a loan. You subtract the expected repayments by the borrower, the expected proceeds from the realization of collateral in case the customer defaults. You might be able to recover some amount of the loan by, for example, using the collateral. And you subtract this as well, and then you have the amount of individual value adjustment. And you have to adjust the value of the loan. And this is actually the same that is also done, for example, by insurance policies. They have to forecast the amount of money they will have to pay out. The bank will have to forecast the amount of money that it is going to receive. And then if their expectation changes, they have to make a value adjustment. Okay. The general provision for doubtful debts, doubtful translation, for troubled assets and troubled debts, I would say, is the default ratio times the risky credit volume. And the default ratio is the average of bad debt loss minus the minimum of the EWB, which stands for Einzelwertberichtung in German. It's a specific valuation allowance if it's done for single loans. And here you can see how the average default ratio can be calculated, and you can do a general adjustment of your loan volume. Okay. Now, derivatives. Derivatives. How are they accounted for? It depends. For options and option rights, they are accounted under A15, the option premium, where it's done on the balance sheet date. You have a possible write-down of the option premium to the lower stock market price, and what is the settlement and exercise at the settlement and exercise date. If the option is exercised or not, you have the purchase price that equals the option premium plus the exercise price, and the sales revenue is the exercise price minus the option premium. What positions do you take? If you have a call, the accounting of the option premium falls under other liabilities. So it's P5 or other provisions. For a put or advances to customers under A4, when you have the balance sheet date, you value it as a possible creation of a provision for impending losses from pending transactions. How do you calculate the provisions? You take the difference between the stock market price on the balance sheet date and passivated option premium, and here you have the same positions on the settlement date. And if it's done for futures, so it's not an option or a call or put, if you have forwards and futures, the initial margins are reported under A4 on the asset side as advances to customers, and you might create a position, in fact a provision for impending losses from pending transactions. How do you calculate the provisions? Take the difference between the forward rate at balance sheet date and the agreed forward rate, which is more or less the difference and the sum of the margins you would need to pay in a forward contract. Does everyone know what a forward and a future contract is? Who does not know a forward or a future? Okay. Who can explain what a forward contract is?
I can try.
Yeah?
It's the other one future or forward contracts, the difference is that a future is a standardized contract and it's a derivative.
Yeah, what does it mean?
That we have
Two parties?
Sorry?
Two parties agree on a contract?
Yeah, two parties agree on the contract that is related to another object. So
And underlying?
another underlying. And it can be, for example, that we both agree that I produce these bottles and you buy them for a price we set today, but we will get them before the bottles I sell you in end of December.
So two parties agree on a contract to buy and to sell a certain underlying with price fixing today and delivery and payment in the future. So I do not immediately buy this and I do not have to immediately pay for this, but we agree on the sale and delivery and payment are due in the future, which means I can fix a price today for a delivery that is due in, let's say, 1 year. A forward contract is the unstandardized version of this contract. Any two parties can agree on a forward contract, and it's usually traded over the counter. The future contract, a future contract is the standardized version of a forward that is traded on an exchange, usually on a futures exchange, like the Chicago Mercantile Exchange, the CME. And a future contract is just like a forward contract with the distinction that it's standardized. The underlying is fixed, of course, and is standardized, and it can be traded on an exchange. Now, forwards and futures, as you can see, they go under A4, and in case you are fearing a loss, you have to build a provision for this. And here you can see the acquisition cost is an agreed forward rate, and the sales revenue is the agreed forward rate. Okay. In case you are buying or selling. Okay. So this is derivatives accounting. Mm-hmm.
Are banks obliged to do or to trade those on the OTC market as well?
Are they obliged to trade?
If they are allowed to buy or sell?
Yes, of course.
Because it's non-standardized.
They are, of course, everyone is allowed, because OTC and non-standardized simply means that there is no readily available security or financial instrument you can simply buy at an exchange. You still need to find a counterparty, and for example, Deutsche Bank might go to Commerzbank and say, we need to sign a forward contract on the stock of BMW or on 1 ton of Brent oil or barrel of Brent oil, and the exact provisions of this contract are as follows. Then they agree on this forward contract and they sign it, and it will never appear on any exchange. So usually a forward contract is not, it has no negative connotation, even although it might sound as if over-the-counter or unstandardized sounds like it's non-standard or risky at any rate. It is risky in the sense that if your counterparty defaults, you will be left with a contract and no contract partner. You might have made a payment and the contract then is void because you have no counterparty left. In a future contract, the stock exchange will guarantee payments. This is the fundamental difference between financial assets that are traded on an exchange and the ones that are OTC traded. Okay. Yep.
Would it also be considered a loss when you sign future or forward contract if the stock price changes so much that if you have sold it then at that date, at the delivery date, you could make much more profit, but now
no.
You have signed the future.
No. You don't. You do not account for potential opportunity costs. So if your contract at one point was worth 1 million and then it goes back to being just 50 euros, you will not account for how should I put it, forsaken profits. Yeah, that's never done on a balance sheet.
So it's only considered in default risk.
Yeah, because in some, especially for derivatives, you sometimes have an unlimited loss potential if you are short. And of course, these loss potentials need to be accounted for, although you will never include an unlimited loss potential. That's quite clear. Okay. Then let's turn to the income statement. The structure and layout of the income statement is also regulated in these Forms 2 and 3 of the Executive Order on the Accounting of Banks in Germany. Unlike non-banks, banks can choose between a single and a double column layout, and this classification is based on different possible criteria. For example, we have a separation of income and expenses from lending business and from non-lending business. I've already told you this, that if you look at the income statement of a bank, you will usually be able to see whether the bank is more active in traditional lending or whether it's also active in investment banking. If it only engages in commercial banking and traditional lending, it will have a lot of income expenses and income, interest income, and it will have no non-interest income. This is the distinction between commercial and investment banking. We have a segregation and separation of operating and value expenses and expenses and income into operational and non-operational components. So let's have a look at this in German. You start with the expenses on the left-hand side, and you can see that you have interest expenses, provisions, Provisionsaufwendung, which is something different, expenses related to non-interest income. And then you have the net expense of trading, and then general administration costs, personnel, social security expenses, other administrative costs, depreciation, write-downs. On the right-hand side, you have interest income. Interest income stemming from these are capital and financial market instruments, fixed income securities, and you have current income from securities, from holdings and other affiliated companies. You have income from other holdings, and this is Provisionserträge, which is in English non-interest income, and provisions and fees. So this is usually the part where all the money from investment banking goes in. You have fees and commissions, and this is usually generated in investment banking. And it goes on, and at the end, you either have a loss or a profit. And this is, as you can see, this is a special way of writing an income statement. As I've said, you have two ways. You can either do it in one column or two columns. This is the version where you have two columns, but you can also put it underneath each other. Then you have the one column version. Net interest income. Again, you can see here, you have interest income from lending, money market transactions, fixed interest securities, current income from shares, investments, holdings. I think this is self-explanatory. The bank will generate net income and net interest income, and you simply have to subtract gross interest expenses from E1 and E2, and then you get net interest income. Net trading income, same thing here. You take A3 and A5, the net expense or income from financial transactions, securities and expense components, realized losses, depreciations, additions to accruals, and you can calculate the net expense or the net income from financial transactions if you're interested in this particular part of the income statement. Okay. Gains and losses from other financial securities and receivables. Now, we've talked about the valuation of the positions on the asset side of the bank, and it's obvious that changes in these values need to be reflected in the income statement. And these are the gains and losses from other securities. For example, the depreciation and valuation allowances on receivables and specific securities, A7, which is income from depreciation of receivables and specific securities, as well as from the reversal of accruals. This is E6. So these are the income and these are the expenses. E stands for Einnahmen, Erträge, and Aufwendung, expenses in German. So you have the valuation result from the lending business, you have depreciations, additions to accruals, but you also have appreciations of receivables, gains from the receipt of written off receivables. Now, if you have written down a receivable, but you do actually get back more money than the position is worth on your balance sheet, you have a profit, you have a gain. And this is the gains from the receipt of written off receivables. Is that clear? Assume you have a loan of 1 million euros. At one point you think, okay, this customer is in default. You write it down to 0. But suddenly, 1 year afterwards, he pays back $600,000 or euros. Then, of course, you have a gain in already written down receivables of 600,000 euros, because the year before that you had a loss of 1 million euro. So this is an income and a gain here. And you have earnings from liquidity reserve securities, again, realized gains and realized losses. And you have a netting option, and then you have the net gain. Net income from investment, the same thing. You take the income from appreciations on shareholdings, shares in associated companies. You have a depreciation on the other side, and you have realized gains and realized losses, and then you have a netting option, and you can net realized gains and losses on these investments. Yeah, I think not too interesting. And then at the end you have your overall net income and the result of your income statement. Okay. Notes and management reports. Under German law, you are required to include notes, and banks also need to include a risk report and a management report. Now, what is included in these reports that are part of the annual report but are not, of course, represented as a certain figure in the balance sheet or income statement? Now, which information has to be provided in the notes is specified in paragraphs 34 to 36 of the executive order on bank accounting. And in addition to this, the general accounting law in the commercial code applies, which is 284 to 287 German commercial code. What type of information has to be included? It can be divided into three categories. Information on the applied accounting and valuation methods. You need to write down why you chose, for example, to include these positions in entry A6, A4, A3. You need to write down for the CPA and for stakeholders what type of valuation methods you used and what results you came up with. Further explanations of the balance sheet and income statement. In some cases, you might be interested in explaining why figures look like this. For example, we just bought a large competitor and we had extraordinary high losses because we bought the competitor. Or we had something else out of the ordinary, and this forced certain figures of the balance sheet or income statement to be different than the average over the last couple of years. Disclosures on off-balance sheet transactions, that is, for example, forward and option transactions as well as swaps or derivatives. Some explanations for derivatives might be included here. And with regard to the management report, there are no special regulations on banks, but of course you have peer pressure. Most large banks have a certain set of information that is given in the management report, and most banks' management reports will look alike. Just take a look at one of these. Okay. Notes, management report, risk report, in which the banks disclose more information on risk management. They are included in the annual report, and this is more or less the accounting under German commercial code. The large banks are forced to do their accounting under international financial reporting standards under Ifrs. There are some few major differences to German commercial code, and I simply want to point these out. Now, as I said, in addition to the balance sheet and income statement under German commercial code, the IFRS annual financial statements include notes and a cash flow statement. And this should provide valuable information to stakeholders on the cash flow reserves of the bank. Financial instruments are significant for accounting and valuation purposes, so financial assets, financial obligations, and equity instruments are included. And they are again divided into those held for trading, those held to maturity, and those held to liquidity, for liquidity. So you have three sections and three parts. The trading and liquidity portfolio is valued at fair value. You have fair value accounting under IFRS, and I guess this is the one major difference between German commercial code and international financial reporting standards. And liabilities are valued at amortized cost. So what's the legal basis for IFRS bank accounting? In fact, a number of IAS international accounting standards that apply to banks. For example, IAS 30. This is the only bank-specific standard that regulates and is concerned with the disclosure and reporting requirements for banks. You have IAS 32, which deals with the disclosure and reporting on obligations for financial instruments across all industries. But again, as banks hold a lot of financial instruments on their balance sheet, this is, of course, one major international accounting standard that is applicable to banks. IAS 39, which acts across industries and contains rules on the accounting and valuation of financial instruments. And 21, which regulates cross-industry currency conversion. Again, large banks engage heavily in financial transactions across the globe, And then, of course, you have foreign exchange risk and instruments that are dealt and marketed in various currencies, and you need IAS 21. Okay. What is the structure of the balance sheet under IFRS? There are no form requirements. There are only recommendations on minimum disclosures, for example, IAS 30, and the number of items in the IFRS balance sheet is significantly lower than in a German balance sheet, because a lot of the information is relegated to the notes. So this is one example. It's in German. You have, again, asset side, liability side. One difference is that it's, again, the other way around. Long-term investments, machines, real estate, and then it goes down to cash at the end. And the liability side starts with equity and then long-term and short-term liabilities. Okay. A financial instrument under IFRS is a contractual agreement which leads to a financial asset at one company and a financial obligation at another company. Now, financial instruments under IFRS therefore cover cash, receivables, option rights, equity instruments, issued debt securities, loans taken, written options, shares, preference shares, warrants, etc. And financial instruments are valued within 4 categories. You have financial instruments at fair value through profit or loss. These are, for example, the trading assets, receivables, shares, derivatives, foreign exchange products, trading liabilities, written options, short sales, and fair value options. And then you have held to maturity, loans and receivables, and available for sale financial assets. These are the ones for liquidity. They are readily available for sale, so they are held for liquidity. And here you can see which financial assets belong to each of these categories. For example, all equity instruments that are not financial assets at fair value, they belong to the category available for sale. So these are held for liquidity. Okay. How do you value assets and liabilities? Financial instruments are valued at the cost of acquisition, and subsequent valuation is done at fair value or amortized cost, depending on their category. In the case of amortized cost, changes in value occur only if the asset is sold or if there are indications of impairment, so that an impairment loss has to be recognized within the balance sheet and income statement. Indications of impairment are an objective indication of a permanent impairment based on a past event after valuation, and if this event affects future cash flows, which is a rather vague definition, but if you study and concentrate on accounting, you will learn more about this. Here at this point, it suffices to say that this is, of course, again, worth a discussion with your CPA and the accounting department, whether you can assume that you have a permanent impairment to the value of your financial asset. Here, again, you can see loans held to maturity. On the asset side, they are done, the valuation is done at amortized cost. You have no treatment of fair value changes. You have to use an impairment test, and the reversal of impairment will affect net income. Assets that are available for sale are always valued at fair value. It's profit neutral. You do an impairment test, and the reversal of impairment can affect net income if it's a debt instrument. If it's an equity instrument, it's profit neutral. And financial instruments at fair value, they are done, valuation is done again at fair value, and liabilities also, depending if you have financial instruments or other liabilities, which are valued at amortized cost. So fair value accounting is much more important here under IFRS, and the reason is for this is that IFRS is more geared at stock market investors. IFRS wants to paint a clearer picture and a more accurate picture of what is going on in the company. It does not want to be overly cautious, just like the German commercial code. So this is why fair value accounting takes up a much larger part here and a much larger role under IFRS accounting. Next, the income statement. Quite standard. Interest income minus interest expenses equals interest surplus, the net interest income minus the risk provisions, interest surplus after risk provisions, and then you have fee and commission income, fee and commission expenses. This is the non-interest income part. And then you can see you have taxes, earnings before taxes, administrative expenses. The most important parts are these, actually. Because banks are not selling goods, they are not producing machines, they are giving out loans, they are accepting deposits, and this is done for interest rates or an investment on a commission or fee basis. So these are the most important sections of the income statement of a bank. Then we have the cash statement. Cash flow statement provides information on the events that caused the change in the cash reserve and provides an insight into the bank's liquidity situation. And it's the annual net profit plus the non-cash effective expenses minus the non-cash effective income, and then you get the change in cash. Cash inflow and outflow can be divided into 3 sections, depending whether it stems from operating, investment, or financing activities. So this first section mainly consists of annual surplus adjusted by non-cash expenses. The second one is connected to the acquisition or sale of financial and tangible assets. And the last one is concerned with self-financing. Cash settlement. It's quite different, but I think it's not as important as understanding the basic principles of the balance sheet and the income statement. And then we have the notes. The notes correspond to the notes for the balance sheet on more or less the annual report under German Commercial Code. And these notes include information about the group relationships, notes to the balance sheet and income statement, in particular, accounting methods, breakdown of remaining terms, detailed information about the composition and valuations of individual bank sheets, bank balance sheet items. For example, if you have financial instruments, you might be inclined to offer more information on the composition of this provision and this entry in the balance sheet. You can give more information if you think your investors will be interested in this, and if you can give out this information. Detailed information about the individual expense or income items in the income statement. Again, if you are under the impression that your investors will need more information to understand the time evolution of your figures in the income statement, if you have an extraordinary high loss, you might be inclined to include more information on this development in the notes. An explanation of the objectives and strategies of the risk management. This is what we usually refer to as the risk report or risk management report. A segment report which breaks down the income and expenses, assets and liabilities, information about events after the balance sheet date, and information about contingencies and other obligations. It's your job as a manager to decide what information to include. This is, again, pretty much regulated by peer pressure and by the market, because most banks just see what information other competitors offer to their stakeholders and shareholders. And most, for example, risk management reports will look the same. They will give you the same set of information. Which methods are you using in your risk management? Do you have a risk committee? How often does the risk committee convene? What is your exposure to market risk, credit risk? Do you have operational risk? Do you have operational risk management in place? This is the type of information that is provided in the notes, and more specifically in the risk management report. Okay. And if you want to have a better understanding of this, I would ask you to simply call up annual report of, say, Citigroup, Bank of America, maybe a French bank and a German bank, and then you can see the similarities and the differences. You will see they are quite alike with respect to many aspects, but there are slight differences, and of course the accounting rules are different, especially an US annual report and a German one will differ quite a lot because of the different accounting standards. Okay. Do you have any questions concerning bank accounting? Yes?
Are these reports simple to understand or are they complex?
Let me put it this way. There are different types of annual reports. One has to be precise. I've shown you what is done and is necessary under law, under German law for banks. And if you take several annual reports that have been filed under the German Commercial Code, they are quite easy to understand, I would say. And German law is quite strict. If you take an annual report from a bank around the globe, the first problem you will have is accounting standards are different. Second problem is that depending on the law and the legal system under which these reports have been filed, it might be that more or less information is included in the annual report. And of course, a problem you will always have with these annual reports, the annual reports provided on the websites of the companies are meant as part of the companies, as part of the bank's investor relations efforts. So these are 500, 600 pages documents that are full with fancy pictures, nice graphs and plots that are meant to inform potential investors and to highlight the sheer numbers provided in the annual report. Now, in many countries, and most notably in the United States, banks also have to file these numbers and their reports with the regulator, with the regulating body. And if you are interested in a very standardized, condensed, maybe 100 or 80 pages long annual report without the marketing info, you have to take the 10K or the 10Q, actually it's capital K, 10K or 10Q filing. These are the filings companies need to make with the SEC if they are registered with the SEC. So the large companies all have to file a 10K or a 10Q filing. Does anyone know what the difference between 10K and 10Q is? Q stands for quarter, and the fourth quarter is also the report for the year. And then you have the first 10Q, the second 10Q, the third 10Q, and the fourth filing is always the 10K, which is for the whole year. What we would refer to as quarterly and annual report. So we have, usually you will take the 10K filing for the annual, on the annual basis. You also have so-called call reports. The 10Q and 10K filings are done and filed with the SEC, and all companies registered with the SEC have to file these reports. So these are banks and non-banks and industrial companies. But you can also have a look at the 10K filing of a bank, of course. Banks, on the other hand, are also, if they are regulated, I think, with the FDIC, they are, I think it's the FDIC. They are forced to file a regulatory report with the, I think, either Fed or FDIC. And these reports are the so-called bank call reports. And these are very short PDFs. They only include the necessary and required information, no pictures, usually no graphs, just sheer information and sheer data. And this is quite easy to understand because you only have the figures. from the balance sheet and income statement. And you can see an extreme difference to the annual reports provided by Investor Relations. Same thing for insurance companies. They also have to report filings with the regulatory body, and these are they are not, I think they are not as easily and freely accessible as the call reports. The call reports are free of charge available on the internet with the FDIC or Fed, I think. With the insurance companies in the US, they have to file regulatory statutory filings and statutory reports. And these are, I think they are provided by the NAIC, the National Association of Insurance Commissioners, but for a fee. So you can download them, but they are not free of charge. But some insurers might probably also report them on their website. But all these companies have fancy reports for investors on their investor relations website. Yeah. Any other questions? Okay, if you have no further questions, thank you for the attendance and for your participation, and I hope you have a great remaining week. Thank you.